When people hear that a giant like JP Morgan lost $2.4 billion, the first reaction is usually disbelief. This is one of the most powerful financial institutions in the world, a bank with access to the best analysts, the most advanced risk models, and decades of market experience. So how does a loss of this magnitude even happen? The answer is uncomfortable for many because it exposes a reality that most retail investors never get to see up close. Even the biggest players are not immune to market dynamics, especially when those dynamics involve leverage, crowded trades, and the brutal mechanics of a short squeeze. To understand what really happened, we need to move beyond headlines and social media hype and look at how short positions work in practice, why they can spiral out of control, and how institutional confidence can quietly turn into institutional vulnerability. A short squeeze is often portrayed as a kind of revenge story where small investors band together and defeat Wall Street, but the truth is far more complex and far less emotional. At its core, a short squeeze is simply a structural problem in the market, one where too many participants are positioned the same way, relying on the assumption that prices will fall, and when that assumption breaks, the exit becomes painfully narrow. Short selling, by design, is asymmetric. When you buy a stock, the maximum you can lose is what you invested. When you short a stock, your potential losses are theoretically unlimited, because there is no ceiling on how high a price can rise. Large institutions understand this risk intellectually, but understanding risk and feeling it in real time are two very different things. In calm markets, short positions can feel controlled, calculated, even boring. The models work, volatility stays contained, and small adverse moves are absorbed without drama. But markets are not static systems. They are driven by human behavior, feedback loops, and sudden shifts in narrative. When a stock starts rising instead of falling, short sellers begin to feel pressure. Margin requirements increase. Risk managers start asking questions. Positions that once seemed safe suddenly demand more capital just to stay open. At a certain point, covering the short becomes less about strategy and more about survival. This is where the squeeze begins. As shorts rush to buy shares to close their positions, their buying pushes the price even higher, which in turn forces more shorts to cover, creating a self-reinforcing loop. In the case of a massive institution, these positions are often spread across desks, strategies, and even different instruments, but the underlying exposure can still converge on the same outcome. The market does not care how sophisticated your internal structure is. It only reacts to supply and demand. When demand overwhelms supply, prices rise, and short sellers pay the price. What makes this situation especially revealing is that it challenges the popular belief that large banks always have an escape plan. In reality, liquidity disappears faster than most models anticipate, especially in moments of stress. When everyone tries to exit at once, the exit is no longer there. The loss is not just financial, it is reputational because it forces institutions to explain how such exposure was allowed to build in the first place. And this is where the deeper lesson begins to emerge. The story is not about one bad trade or one unexpected rally. It is about how modern markets reward confidence right up until the moment they punish it. Institutions operate under the assumption that they can manage risk dynamically, adjusting positions as conditions change. But short squeezes compress time. They turn gradual risk into sudden crisis. Decisions that would normally be spread out over weeks or months must be made in hours or even minutes. At that speed, even the best systems struggle. This is why losses like this feel shocking, not because they are impossible, but because they reveal how fragile control can be when the market moves against consensus. And as we move forward, the most important question is not who is to blame, but what this tells us about the real nature of risk in today's financial system, and why these events may become more common, not less. To really grasp why a loss like this can happen, we need to strip away the myth that institutional trading is purely mechanical and emotionless. Behind every model, every hedge, and every risk limit, there are human decisions layered on top of assumptions. One of the most dangerous assumptions in modern finance is that liquidity will always be available when you need it. In normal conditions, this feels true. Markets are deep, spreads are tight, and large orders can be executed with minimal impact. But a short squeeze exists precisely because liquidity is not guaranteed. It vanishes when it is needed the most. When too many participants are short the same asset, they are all depending on the same future outcome. They are betting not only on price direction, but also on the idea that they will be able to exit calmly if things go wrong. That assumption is fragile. Once prices begin to rise aggressively, the psychology of the trade shifts. What was once a calculated position becomes a liability that grows larger with every tick upward. For a large institution, this pressure is magnified by leverage. Leverage is not inherently bad. It is a tool, and like any tool, it amplifies both efficiency and risk. Banks use leverage to optimize capital, increase returns, and remain competitive. The problem arises when leverage intersects with crowding. A crowded short trade is like a room with too many people and only one door. As long as no one panics, it feels manageable. But the moment panic sets in, movement becomes impossible. Margin calls accelerate this process. As prices rise, brokers demand more collateral. That collateral must come from somewhere, often forcing institutions to sell other assets or close positions they would prefer to keep. This creates secondary effects in the market, spreading stress beyond the original trade. Losses compound, not because the initial thesis was completely wrong, but because the structure of the trade cannot withstand volatility. Another misunderstood aspect of short squeezes is timing. Many short sellers are not fundamentally wrong in their long-term view. They may believe a company is overvalued, poorly managed, or structurally weak. In some cases, they are eventually proven right. But markets do not move on fundamental timelines. They move on liquidity and momentum. A stock can stay irrational longer than a short seller can stay solvent. This phrase is repeated so often that it risks becoming cliché, but events like this prove its relevance. Institutional investors often believe they can outlast temporary price spikes, especially if they trust their analysis, but when the spike is fueled by forced buying rather than organic demand, it can reach levels that invalidate any rational time frame. At that point, the question is no longer whether the original thesis will eventually play out, but whether the institution can survive long enough to see it happen. This is where reputational pressure enters the equation. Large banks are not just managing money, they are managing perception. A rapidly growing loss attracts attention from regulators, shareholders, and the media. Risk committees become more conservative under scrutiny. Positions that might have been held under different circumstances are closed to demonstrate control and responsibility. Ironically, this defense behavior can worsen the squeeze. Forced discipline replaces strategic patience. What is especially revealing is how these events expose the limits of diversification. Many assume that large institutions are protected because they are diversified across assets, strategies, and markets. While diversification reduces certain types of risk, it does not eliminate systemic behavior. If multiple strategies share exposure to the same underlying factor, such as volatility or momentum, they can all suffer simultaneously. In a short squeeze, correlations move toward one. Assets that were previously unrelated begin to react in the same direction as capital is pulled to meet margin requirements. The system tightens. What looks like a single loss on paper is often the visible symptom of broader stress behind the scenes. This is why losses of this scale are rarely isolated incidents. They are moments where hidden connections become visible. And this brings us to a critical realization. The market does not punish ignorance as harshly as it punishes overconfidence. Institutions are aware of short squeeze risk, but familiarity breeds complacency. When a strategy has worked repeatedly, it becomes easier to assume it will continue to work. Controls loosen subtly, position sizes grow incrementally. The trade becomes part of the background noise of daily operations. Then, when conditions change abruptly, there is no gradual adjustment, only a sharp correction. This is the reality behind the headlines. Not a single reckless bet, but a slow buildup of exposure that only becomes obvious when it is too late. Another layer that often gets overlooked in discussions about short squeezes is how modern market structure accelerates everything. Algorithms, high-frequency trading, and automated risk controls are designed to react instantly to price movements. Under normal conditions, this creates efficiency. Under stress, it creates amplification. When prices begin to rise rapidly, algorithms that are programmed to reduce risk do exactly that. They buy to close short exposure. This buying is not based on analysis or emotion. It is mechanical, and because it happens at scale, it adds fuel to the fire. What once might have been a gradual squeeze over days can now unfold in hours. This speed leaves little room for human intervention. By the time traders recognize that a situation has escalated beyond expectations, the majority of the damage may already be done. This is especially problematic for large institutions, where decision-making involves multiple layers of approval. Speed becomes an enemy. The market moves faster than governance structures can respond. In these moments, even institutions that pride themselves on discipline are forced into reactive behavior. They are no longer shaping outcomes, they are responding to them. This dynamic reveals a deeper truth about risk models. Most models are built on historical data. They assume that future behavior will resemble the past within a defined range of variation. Short squeezes break this assumption. They are nonlinear events. Price moves are not incremental, they are explosive. Volatility does not rise gradually, it spikes. Correlations that normally remain stable suddenly collapse into uniformity. In these environments, models underestimate risk precisely when accurate estimation matters most. This is not because the models are poorly designed, but because reality occasionally moves outside the boundaries they were built to handle. Institutions know this, yet they continue to rely on these tools because there are few alternatives. You cannot run a global financial operation without models. The danger arises when model outputs are treated as certainty rather than guidance. Over time, this reliance can dull intuition. When numbers say a position is safe, it becomes easier to ignore weak signals that suggest otherwise. Short squeezes punish this mindset brutally. They remind the market that uncertainty cannot be fully quantified. Another important aspect is narrative. Markets do not move solely on fundamentals, they move on stories. When a stock becomes associated with a narrative of scarcity, defiance, or inevitability, that narrative can attract capital regardless of valuation. For short sellers, narratives are dangerous because they can sustain price levels far beyond what fundamentals justify. Institutions often believe they can wait for reality to reassert itself, but narratives can persist longer than expected, especially when they are reinforced by price action. Rising prices validate the story, attracting more buyers, which pushes prices higher still. This feedback loop is particularly powerful in the age of social media and instant information flow. Sentiment spreads faster than analysis. By the time a narrative peaks, positioning is already extreme. From the outside, it may look irrational, but from within the market, it feels unstoppable. This creates a psychological trap for short sellers. Closing the position feels like admitting defeat, not just financially, but intellectually. For institutions built on the belief that they understand markets better than most, this is a difficult pill to swallow. Yet the market does not reward pride. It rewards adaptability. Losses like this force a reckoning. They compel institutions to revisit internal processes, reassess risk limits, and question long-held assumptions. But they also raise an uncomfortable question for the broader system. If institutions with vast resources, advanced technology, and deep expertise can still be caught off guard, what does that say about market stability as a whole? The answer is not that markets are broken, but that they are inherently fragile during periods of extreme positioning. Stability is often an illusion created by calm conditions. Stress reveals structure, and the structure of modern markets is tightly interconnected, fast-moving, and highly sensitive to feedback loops. This does not mean short selling is inherently flawed or that institutions should avoid it altogether. Short selling plays a vital role in price discovery and risk management. But events like this highlight the need for humility. They show that no amount of sophistication can eliminate uncertainty. Risk can be managed, but it cannot be erased. For viewers, especially those watching from the outside, the key lesson is not to romanticize these events or reduce them to simple winners and losers. The real story is about how quickly confidence can turn into exposure, how assumptions can quietly stack on top of each other, and how the market eventually forces those assumptions into the open. As we continue, the most important takeaway is not the size of the loss itself, but what it reveals about behavior under pressure, and why understanding these dynamics matters not just for institutions, but for anyone participating in financial markets. One of the most revealing aspects of events like this is how they change behavior after the fact. Losses of this magnitude do not just disappear into quarterly reports, they reshape internal culture. Risk teams become more conservative, position limits are tightened, and strategies that once felt acceptable are suddenly questioned. But this reaction often comes with a trade-off. When institutions pull back too aggressively, they may avoid future losses, but they also risk missing future opportunities. This creates a cycle where fear replaces confidence, just as confidence once replaced caution. The market has a way of pushing participants from one extreme to the other. What makes short squeezes particularly influential is that they do not simply punish bad analysis, they punish imbalance. A short position can be well-researched, fundamentally sound, and still fail if too many others share the same view at the same time. This is a difficult concept for many investors to accept because it means being right is not enough. Timing, positioning, and crowd behavior matter just as much as analysis. For large institutions, this creates a structural challenge. They manage enormous pools of capital, which limits their flexibility. They cannot enter or exit positions quietly. Every move leaves a footprint. When conditions are calm, this is manageable. When conditions are stressed, size becomes a liability. The very scale that provides influence and efficiency in normal markets becomes a constraint during volatility. This is why short squeezes often target large players, not because they are careless, but because they are visible and slow relative to the speed of market reactions. Another underappreciated factor is how internal incentives can unintentionally contribute to risk buildup. Traders are often rewarded for performance over defined periods. Strategies that generate consistent gains tend to attract more capital. Over time, this success reinforces belief in the strategy's robustness. Risk controls may adjust, but they often lag performance. This is not due to negligence, but because reducing exposure during profitable periods can feel unjustified. When the environment changes, the accumulated exposure reveals itself all at once. Short squeezes act like stress tests that no institution willingly signs up for. They expose where incentives, assumptions, and controls have quietly drifted out of alignment. There's also a broader lesson here about transparency. In modern markets, information travels quickly, but understanding does not. Headlines focus on the dollar amount lost, but they rarely explain the mechanics that led there. This creates a distorted perception of risk, especially among retail participants. Some interpret these losses as evidence that markets are rigged or that institutions are incompetent. The reality is more nuanced. Markets are complex systems where outcomes are shaped by interaction effects rather than single decisions. No one participant controls the whole. When many participants respond to the same signals, the collective behavior can overwhelm individual intent. This is why systemic events feel so sudden. They are the result of gradual alignment followed by rapid release. For individual viewers, this insight is crucial. It suggests that managing risk is less about predicting outcomes and more about surviving uncertainty. The goal is not to avoid every loss, but to avoid losses that are large enough to remove you from the game. Institutions understand this principle, but events like this show how difficult it is to apply consistently in practice. Pressure, competition, and the desire for returns all push against restraint. Short squeezes strip away these justifications and leave only consequences. They force participants to confront uncomfortable truths about their own tolerance for uncertainty. As we approach the final stages of this discussion, it becomes clear that the real impact of a loss like this extends far beyond one balance sheet. It influences how capital is allocated, how strategies are evaluated, and how risk is perceived across the market. It becomes part of collective memory, shaping decisions long after prices have stabilized. The question is not whether short squeezes will happen again, but whether participants will truly internalize the lessons they offer. History suggests that memory fades as conditions normalize, confidence returns, exposure grows, and the cycle quietly begins again. Understanding this pattern is not about cynicism, it is about realism. Markets are not moral systems. They do not reward virtue or punish arrogance in a predictable way. They respond to structure, incentives, and behavior. When those elements align in unstable ways, outcomes follow. Recognizing this does not eliminate risk, but it gives participants a chance to respect it. And in markets, respect for risk is often the only sustainable advantage. At this point, it is worth stepping back and asking why stories like this capture so much attention. It is not just the size of the loss, although $2.4 billion is a number that naturally draws headlines. It is what the loss represents. It challenges the comforting idea that markets are always under control, that sophisticated players have mapped every scenario, and that risk can be neatly contained. Events like this disrupt that narrative. They remind everyone that markets are adaptive systems, not machines. They evolve as participants learn, react, and reposition. What worked in one environment can fail spectacularly in another. This is especially relevant in a period where volatility regimes can shift rapidly. Low volatility conditions encourage leverage and risk-taking. Strategies that rely on stability flourish. Over time, these strategies become dominant. Capital flows toward them. The system becomes optimized for calm, but calm is not permanent. When volatility returns, the system is suddenly misaligned with reality. Short squeezes are one expression of that misalignment. They are not anomalies, they are signals. They indicate that positioning has become too one-sided, that assumptions have converged too tightly, and that flexibility has been sacrificed for efficiency. For institutions, adapting to this reality is difficult because it requires accepting lower returns during good times in exchange for resilience during bad times. This trade-off is easy to describe, but hard to implement. Shareholders expect performance. Competitors push boundaries. Falling behind feels riskier than pushing forward. In that environment, restraint can look like weakness. Short squeezes expose how dangerous that mindset can be. They show that the cost of ignoring tail risk is not incremental, it is exponential. For individual investors watching from the sidelines, there is a temptation to view these events as entertainment or validation. Some see them as proof that large institutions are vulnerable. Others see them as cautionary tales about the dangers of short selling. Both interpretations miss the deeper lesson. The real takeaway is about structure and behavior, not size or status. The same forces that pressure a global bank operate on a smaller scale in individual portfolios. Overconfidence, crowding, leverage, and narrative can affect anyone. The difference is scale, not nature. When a retail investor faces a short squeeze, the consequences may be personal rather than systemic, but the underlying dynamics are identical. This is why understanding these mechanisms matters. It shifts focus away from prediction and toward preparation. You cannot control market outcomes, but you can control exposure. You cannot eliminate uncertainty, but you can decide how vulnerable you are to it. Institutions spend enormous resources on this problem, and yet they still get caught. That alone should inspire humility. As markets continue to evolve, the frequency of these events may increase rather than decrease. Faster information flow, algorithmic trading, and global interconnectedness compress reaction times. Extremes form more quickly. Corrections happen more violently. In this environment, patience and adaptability become more valuable than conviction. Short squeezes punish rigidity. They reward flexibility, even if that flexibility feels uncomfortable in the moment. This does not mean abandoning research or discipline. It means recognizing that no analysis is complete without considering positioning and sentiment. Fundamentals matter, but they do not operate in isolation. Price is the intersection of belief, behavior, and constraint. When those elements align in unstable ways, reality asserts itself through volatility. Losses like this are reminders of that fact. They are not failures of intelligence, but failures of balance. As we move toward the conclusion of this discussion, it becomes clear that the most important insight is not about P. Morgan specifically, but about the environment in which all market participants operate. Risk is not evenly distributed. It accumulates quietly and reveals itself suddenly. The role of discipline is not to eliminate risk, but to recognize when it is building beneath the surface. That awareness is rare, even among professionals, which is why these events continue to surprise, and why they continue to teach the same lesson over and over again to anyone willing to look beyond the headline number and ask what it really means. As we approach the final layer of this story, it becomes important to confront a subtle but powerful misconception about market intelligence. Many people believe that losses like this happen because someone failed to see something obvious. That assumption feels comforting because it implies that with enough knowledge, enough data, or enough skill, these outcomes can be avoided. The reality is far more unsettling. In many cases, everyone sees the risk. They simply underestimate how quickly it can materialize and how violently it can cascade. Risk is not just about probability, it is about impact. A short squeeze may feel unlikely on any given day, but when it happens, the magnitude of the move can overwhelm years of careful gains. This asymmetry is what makes it so dangerous. Institutions are aware of this dynamic, yet they still operate within a framework that prioritizes efficiency. Capital must be deployed. Sitting on the sidelines has a cost. Over time, this pressure creates an environment where exposure quietly grows, not because participants are reckless, but because restraint is difficult to justify when conditions appear stable. This is how vulnerability builds in plain sight. Another critical element is how success shapes perception. When strategies work repeatedly, they become normalized. Risk feels abstract. Losses are theoretical. Overconfidence rarely announces itself loudly. It creeps in through familiarity. The more often a position survives small shocks, the more resilient it appears. This creates a false sense of durability. Short squeezes dismantle that illusion instantly. They remind participants that resilience is not tested in calm conditions, but in extreme ones. And extremes rarely arrive with warning. They emerge from alignment. When positioning, sentiment, and structure all lean in the same direction, tension accumulates. The release is sudden and unforgiving. For institutions, managing this tension is one of the hardest challenges in finance. Internal discussions often revolve around trade-offs. Reduce exposure and risk underperforming peers, or maintain exposure and risk a tail event? Neither option is comfortable. The decision is rarely clear-cut. This is why hindsight can be misleading. After the fact, the correct action seems obvious. In real time, it is anything but. The market does not provide certainty, only information, and that information is always incomplete. This is where discipline must coexist with humility. Discipline without humility becomes rigidity. Humility without discipline becomes indecision. Short squeezes exploit imbalance between the two. They punish those who believe too strongly in their models and those who ignore them entirely. The lesson is not to abandon structure, but to remain aware of its limits. For viewers, especially those seeking to understand markets at a deeper level, this distinction is crucial. Markets reward those who respect uncertainty, not those who deny it. The most resilient participants are not the ones who predict every move correctly, but the ones who survive being wrong. This perspective shifts the goal from winning individual battles to staying in the game long enough to benefit from long-term opportunities. Institutions, despite their size and sophistication, are subject to the same rule. They may survive losses like this, but each event leaves a mark. It influences future decisions, shapes risk culture, and alters how aggressively capital is deployed. Over time, these adjustments ripple outward, affecting liquidity, volatility, and pricing across the market. This is why individual events matter even when the system absorbs them. They are part of an ongoing feedback loop between experience and behavior. As this story draws toward its conclusion, the most valuable insight is not technical, but philosophical. Markets are not environments of certainty. They are environments of choice under uncertainty. Every position is a bet, whether acknowledged or not. The danger lies not in taking bets, but in forgetting that they are bets. Short squeezes are moments when the market forces that reminder upon participants in the most dramatic way possible. They compress lessons that would normally unfold slowly into a single, unforgettable episode. And while the headlines will fade and attention will move on, the underlying dynamics remain. They will resurface in different forms, under different names, and different assets. The participants may change, but the structure will not. Understanding that continuity is what separates surface-level awareness from real insight. And it is that insight that allows market participants, large and small, to approach risk not with fear or arrogance, but with respect. When we step back and look at everything this event represents, it becomes clear that the true lesson has very little to do with a single institution or a single trade. The loss itself is not the most important detail. What matters is what it reveals about how risk accumulates, how confidence forms, and how quickly stability can give way to stress. Markets are often described as forward-looking, but in reality, they are deeply shaped by the present. They reflect current positioning, current incentives, and current beliefs. When those elements align too tightly, fragility increases. Short squeezes are not random accidents. They are the visible outcome of invisible alignment. For many viewers, the temptation is to search for villains or heroes, to frame the story as a battle between powerful institutions and the rest of the market. That framing may be emotionally satisfying, but it obscures the real insight. Markets are not adversarial in a moral sense. They are adaptive systems that respond to pressure wherever it appears. When pressure becomes concentrated, release is inevitable. Understanding this shifts the focus away from blame and toward awareness. It encourages a more mature view of participation, one where the goal is not to outsmart everyone else, but to understand the environment well enough to avoid being trapped by it. This perspective is especially important in an era where access to markets is broader than ever. More participants, more leverage, faster execution, and constant information flow all contribute to tighter feedback loops. Moves that once took weeks now unfold in days or hours. In this environment, the margin for error shrinks. Conviction without flexibility becomes dangerous. Flexibility without a framework becomes chaotic. The balance between the two is where resilience lives. For institutions, this balance is constantly tested by competition and expectation. For individuals, it is tested by emotion and narrative. The forces are different, but the challenge is the same. Respect uncertainty, manage exposure, stay adaptable. The market does not require perfection, but it does punish blindness. Events like this are reminders, not warnings. Warnings can be ignored. Reminders are harder to dismiss because they are grounded in reality. They show what happens when assumptions are pushed to their limits. They demonstrate that risk does not announce itself loudly as it builds. It waits, and when it finally emerges, it does so with speed and force. The value in understanding this story is not that it helps predict the next short squeeze, but that it sharpens awareness of conditions that make extreme outcomes possible. That awareness is what allows participants to step back when others lean forward, to question comfort when it feels most justified, and to prioritize survival over certainty. In markets, longevity is underrated. The ability to stay engaged across cycles matters more than any single outcome. Losses, even large ones, are part of the landscape. What defines success is not avoiding them entirely, but ensuring they are survivable. As attention moves on and new headlines take their place, the dynamics discussed here will continue to operate quietly beneath the surface. They will shape future rallies, future collapses, and future surprises. Whether those moments become lessons or liabilities depends on how well participants internalize what events like this reveal. If this breakdown helped you see the market from a deeper perspective, not as a place of simple cause and effect, but as a system driven by behavior, structure, and pressure, then the story has served its purpose. Keep questioning headlines. Keep looking beyond the surface. And if you want to continue exploring how these dynamics play out across different market events, make sure to keep watching the next videos on this channel and subscribe, so you don't miss what comes next.